Hey everyone, welcome back to LY Learn. In today's session, we're diving into some core finance concepts while I take notes on the iPad. So grab your drink, put your phone on Do Not Disturb, and let's focus together. This is a calm, note-taking video all about capital asset pricing, simplified and made to actually make sense. So the first, we will be talking about capital allocation line or CAL slope. So the formula looks like this, where Y is how much of your money you should invest in the market, ERM is the market risk premium, and RF is risk free. A stands for your risk aversion, and then the denominator, it's markets volatility. So this actually tells us the best way to split our money between a risky portfolio and a risk-free asset. So basically, this formula helps you figure out how aggressive or conservative your investment mix should be. And now let's talk about market risk premium expression. So let's rearrange the formula to get this. This is basically the same one, but it's now rearranged. So this shows that the market risk premium is driven by two things: how much risk investors can tolerate and how volatile the market is. If everyone's feeling cautious or the market's super shaky, you'll need more return to justify investing. Now, the third formula we're going to talk about is risk-return trade-off condition. So the formula looks like this. Now we are also talking about covariance in this formula to know the correlation of what is it going on. So basically what it means is every risky asset should deliver return in proportion to how much it moves with the market. So this basically leads directly into CAPM. So if you invest and your asset is highly sensitive to market movements, it better give you a return that reflects that risk. Okay, I'm just gonna write the title, formulas. Dive into another formula that we're going to talk about today. Security market line, SML, or the CAPM formula. So now we are at the heart of it, the security market line. Okay, so let's talk about the formula in here. This will be kind of familiar because we have talked about this before as well. So basically this tells you the expected return of a stock, but based on its beta. It's risk compared to the market. The more volatile a stock is relative to the market, the more return you should expect from it. So this is like simple, fair, and smart. This is the same thing, but just in here in security market line, we're also talking about beta. We have talked about expected returns. Okay, now let's see the fifth concept, which we have is beta, measuring risk. So first we'll talk about what's beta. Beta measures how much a stock moves with the market. So this is the formula. So there are like two forms of this. So first is covariance and then the other one is correlation. So beta is key in understanding how sensitive your investments are to market movements. So high beta, more than 1, means it moves more than the market. So basically higher risk, higher potential reward. And if we talk about a beta below 1, means it's more stable, but it moves less than the market. And you must be thinking about negative beta. So this is basically which moves opposite direction of the market. It is rare, but it's interesting. So that's it. We'll talk about 5 concepts. If you want more videos on any concept, do comment. So finance concepts can feel complicated, but when you slow down and break it down, they start to make sense. Thanks for studying with me today. If you found this helpful, don't forget to like, subscribe, and share this with someone on the same learning journey. Keep learning, keep growing. I'll see you in the next one. All the best. Thanks for watching.